The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and thank you for joining us today for our webinar, Rising Gas Prices Effect on Transportation Industry. My name is Amanda Lambert. I'm the Marketing Event Coordinator at REMI, and I'll be your host today. Regional Economical Models, Inc. is also known as we are a leading provider of dynamic, economic, and demographic modeling software and consulting. Today's webinar will be presented by Cassazza and Philp Meneghini. They have been REMI associates for almost 2 years now, and David focuses on the transportation and SCI products in the West Coast region with a focus on MPOs. Phil focuses in the Midwest and New England regions, helping clients with public policy and transportation and infrastructure investments. This webinar will last for about 1 hour, leaving the last 10 minutes for your questions that the REMI associates will answer to the best of their ability. The slides and recording of this webinar will be emailed to you 1 hour after the webinar. So without further ado, I will hand this webinar off to David.
Great, thanks so much, Amanda. Hello, everyone. Thanks so much again for attending our webinar. It's definitely a big topic of interest for people of all kind of stripes, but particularly those in the transportation industry. So in the interest of everyone's time, I'll kind of jump right in here. So kind of just a quick agenda overview. I'll be going over the different topics at hand, then we'll go over the potential impacts. I'll be handing things off to Phil for the model demonstration and some of the more notable results. And then we'll kind of bring up some kind of conclusion or discussion points, and that'll be followed finally by the Q&A portion. So kind of a recap just for everybody's point of reference. Obviously 2020 had a huge impact, not just on simple transportation, just due to people not traveling as much or almost none at all, but also on freight. It also had a huge impact on the price of petroleum. We saw, I think at different times, it shot down to like in pretty insane low levels. But since then, obviously, those levels have increased. 2021 saw the passage of the infrastructure bill from the Biden administration, with the emphasis being on facilitating particularly auto travel, but also rail and other forms of alternative forms of travel. And of partial interest there was also a separate measure to end drilling on federal lands by the Biden administration. And this came in also with sporadic decreases in COVID. Obviously, those decreases in COVID have gotten more so in 2022, but those hopes of kind of return to normalcy have been somewhat diminished by the Russia-Ukraine war of recent note, with a major impact on global oil prices. According to Market Watch, this was most recently today. Since the beginning of the year, they've been shot up 41%. I think since last year, it's around up 70%. Obviously, those were lower levels before, but still fairly unprecedented times in terms of the cost of all petroleum products. And partially in response to that, the Biden administration restarted oil and gas leases on federal lands in some limited capacity. So why was there an increase in the gas price? Obviously, an end to the drilling of federal lands. There's kind of some give and take with the global market. It's not just simply siphoning, U.S. oil into the U.S. market, but it still does have an impact. And then obviously with supply chain issues, and the biggest problem being Russia's kind of the change of Russia's role with the world economy. Russian oil makes up about 10% of U.S. imports, so while not being as substantial as a country like Canada, for example, it still has had a great impact on not just the U.S. economy, but the world economy. And oil being one of the main drivers also of inflation, which has been another topic of interest more recently. So some of the more potential impacts. In order to analyze these impacts, we at REMI enjoy using the REMI model because of its kind of comprehensive approach to regional economy, whether it's the labor market and consumer behavior, so looking at kind of demographic data that it brings in from BLS and BEA and other sources, census, as well as looking at the economic impact aided by its generally equilibrium kind of format and the input-output capabilities. And of course, this being a question for about oil and gas and its role in our, not just our economy, but really our lives, the carbon impact is always of great concern, and concerns of equity and you know, really kind of where we go from here. So kind of two big solutions, and these have been proposed by different parties and by different advocates to differing degrees. Obviously, the diversion from fossil fuels is the primary focus. So the use of EVs and fuel cells, public transit, and other measures for consumers, as well as for these larger transportation and freight networks. It helps to kind of insulate the U.S. economy from these, you know, geopolitical shocks to the world oil market in a way that, you know, if we're able to produce our own energy and put that energy directly into the transportation industry, then it kind of insulates us from those kind of events. However, it is a longer term solution in many ways, due in large part to the infrastructure required for electric vehicles and fuel cells, and also just the kind of the realignment of the infrastructure to these other means. Another solution, or a partial solution, is the increase in drilling in the United States. Again, this would be kind of diluted or moved through the global oil market, but it is relatively a short-term solution, which is a positive and a negative. It can kind of patch the holes that we're seeing with this issue of a lack of access to oil. And obviously, the biggest issue with this being that it doesn't address really the larger issues of climate change and sustainability. So now we're going to move over to the actual model demonstration, and so I'll be handing it off to Phil.
Yeah, happy to do the model demonstration here. So we did a pretty straightforward demonstration to start out with. We used our core economic model, Policy Insight PI+, which is very useful at you know, conducting dynamic macroeconomic impact analysis and just analyzing public policy. Over here is a diagram that looks at all the different linkages in the model. So this is really useful when looking at and seeing how different variables are impacted by different factors. So this is really useful when trying to decide, well, why are we getting this certain result from the REMI model? This is a really good resource to look at. And I'm looking at, for this demonstration, I used a global or a national model of the US, and I had a regional model of each of the states within that giant US model. So we can look at all the different states' impacts as well as the impacts on the entire country. We also broke out some of the California counties since California is so large, but this was really good to look at the impacts across the country in terms of, you know, trade flows, trade shares, which are really important for transportation, as well as looking at different regional transportation industries. But, you know, for the majority of this demonstration, we're going to be looking at, you know, the country as a whole, but this provides good insight. And so some of the inputs that I put into the REMI model, so this was modeling that we assumed that there's just going to be a 20% increase in gas and oil prices. You know, gas and oil is moving every single day, and depending on where you want to start, you know, when you start your reference point, you know, it could be up, you know, 40%, it could be up, you know, 60%, 10%. We decided to take 20%, just, you know, assume 20% for this model demonstration. So we had two variables that were important. So we looked at the oil cost increase on the industry side. So looking at the oil cost price effect on all the industries. So that's the first variable that I have listed here, the fuel cost variable. And we increased it by 20% starting in 2022. And then we did the same thing on the consumer side. So we did a price increase on the consumer side with the consumer price variable that looks at increasing the motor vehicle fuels price by 20% starting in 2022 as well. And we did both of these across all the different regions across the entire United States. And here are some of the results. So, this is the general economic indicators or the economic overview results that we got when we ran the simulation. And, we have some of the key economic indicators here like employment, labor force, disposable personal income, GDP, and the population. But, as you can see, everything's going down. Employment, especially employment, seems to dip down really quickly as industries see increased prices in fuels, something that they can't really, prevent. They, probably are laying a bunch of people off. And then as the industries become adjusted to this new fuel price, you can see employment starts to go back up again. But you can see that, GDP, which is outlined in green, goes down and goes up a little bit and then just goes back down again. So GDP is, continuing to sink and level off so the economy in general is not looking good. But, employment, starts to rebound a little bit. But in general, these fuel prices are very detrimental to the general economy. And then, we looked at the prices associated with travel. So we looked at this 20% increase, and I looked at all the consumption commodity prices results, and I sorted it by the ones that were that had the highest price increases. And in the top 5, of course, we see motor vehicle fuels because we're artificially increasing that. That had a huge jump, but also transportation was right underneath that. Transportation, postal and delivery services, water transportation, ground transportation, they all saw the biggest increases in price. And you see this on the news, and you see this in different articles talking about, and you see this when you travel. You can see prices are, continuing to go up with this increase in fuel prices. Transportation is, especially dependent on the cost of fuel, as every industry is, but especially transportation. So they are being disproportionately impacted, and seeing a big increase in the costs associated with transportation. And this goes into a little bit of the demand. So we're assuming, I'm sure that you see articles now, looking at, how, there's an increased demand for air travel, and there's a lot of things with COVID and pent up demand. But for the sake of this webinar, we're just looking at just the direct impacts from this fuel price increase. So just looking at the direct impacts of this fuel price increase, we're seeing the transportation industry, since it's very dependent on fuel prices, is having a huge decrease in demand. And that may not be the way that it's entirely playing out right now, but this is what the direct impact is from that fuel price increase on the transportation industry. And, we're seeing, air travel, which is that line, that dark green line on the bottom is, impacted the most, and it's seeing the biggest decreases and continued decrease with the fuel price increase. It uses the most fuel. It's the most dependent on the price. And then we're also seeing trucking, which is that other line, being disproportionately impacted and, really hurting the most. And, rail and water transportation are impacted as well, but not nearly as much as trucking and the air transportation industry. And to go back to the prices, so we looked at the model, and then we looked at the relative input costs. So we wanted to look into a little deeper, to do a deeper dive into see, well, why are prices going up? And a good way to look at that is the relative input costs for the different industries. So we looked at, in the transportation industry, we looked at their relative input costs in all transportation industries, and we saw sharp increases in the costs and continued increases in the input costs associated with these fuel price increases. We're seeing air transportation and truck transportation again are the losers in the situation due to how much fuel they consume. So they have the highest increase in input costs, which is likely what's leading to them having increased costs to consumers and businesses as a result. Yeah, and so if we look here, we can see a lot of these industries, in order to account for this drop in demand, as well as these increased prices that these companies are facing. We're seeing that a lot of what they're doing is decreasing, laying people off, and there's a huge increase in unemployment in these industries. Specifically, proportionally, the air transportation industry is laying off the most amount of people. The first year they're laying off 1.7%, and that goes up to 1.8% in 2027. But overall, we're seeing trucking is laying off the most people, but that starts to rebound a little bit as a little bit of an opposite trend than the air transportation industry. So we're seeing them, the truck transportation industry laying off 22,000 people in 2022, and that decreases a little bit, but then starts to go back up a little bit and rebound to 14,000 people being laid off. And so to dive a little bit more into these employment numbers, so we're seeing in the transportation industry, we looked specifically at air transportation and truck transportation, since these seem to be the ones that are hurting the most. And these pie charts looked at who exactly and what occupations in these industries are being laid off. We looked at in air transportation, or in truck transportation, we saw that they're predominantly laying off motor vehicle operators to start out with, as well as material moving workers. So a lot of lower skilled labor, they're laying off with decreased demands. There's decreased demand for trucking. They're laying off more of these people to also cut costs due to the increased cost of fuel as well. We're seeing the same thing in air transportation. We're seeing air transportation workers being laid off the most, as well as material moving workers. Also information and record clerks. Since there's less flights going on, less of a demand, there's less of a need for those people with that skill expertise. So we're seeing, and that's probably why we're seeing a kind of a rebound of the employment a little bit from in the truck transportation industry, because they're predominantly laying off motor vehicle operators, and motor vehicle operators are very important for the trucking industry, and keeping that going. So they're probably with the fuel price increase, they're seeing an increase in expenditures and an increase in those expenditures for fuel price, and then they're probably laying off these truckers, and then realizing that they need them in order to keep the business truck transportation moving forward. So they're probably hiring some of them back, and that's probably what that that little bit of shift is that we saw on the employment previously. But yeah. And then we looked at, so we examined, there's a decrease in demand for transportation, and that's largely being driven by the economic reality of the situation. Consumers have less money. They're spending more on fuel, as well as, fuel prices are increasing. So input prices are increasing. So the costs of transportation are increasing as well. And so those are both leading to a decrease in demand of transportation. And, I wanted to look at, well, how is that impacting trade across the different states? I looked at Idaho, and you can see that, with this decrease in demand and increased fuel cost, that there's just a decrease of trade flow between the states. So looking at Idaho, we're seeing in 2022, we're seeing a pretty large decrease in dollars being traded to other states, to all these other states. And looking out to 2060, it's a similar picture, similar numbers. We're still having that extremely reduced trade, and that harms the economy even further. And we can see this across all the different states. I specifically snipped out and looked at Idaho, but we can look at all the other states, and they're all seeing reductions in trade flows and decreased economic activity and trade of between all industries due to this decline in the transportation industry. And so this is kind of a simplified way to look at what the model demonstration illustrated. So we're seeing higher gas prices. This is looking specifically at the transportation industry. We're seeing higher gas prices, and that's leading to disproportionate increases in transportation costs. And since there's an increased cost in transportation now, we're seeing a reduced demand for transportation. And as a result, we're seeing reduced trade and commodity access for the economy, which is further harming the economy. Then again, that impacts the economy even further. But there's some other factors here that we touched on as well. This is like a simplified way to think of what's going on specifically in the transportation industry.
Yeah, and obviously, while kind of a 10,000-foot view of the economic workings here is useful, it's also important to keep in mind different regional as well as modal and frankly just situational differences, and how that has an effect on consumers as well as on industries. So this is the most recent updates of the average gasoline prices across different states. You can kind of see about what you would expect, where the coastal states, particularly California, I think just breached $6 a gallon for regular on average. They're tending to have the highest fuel prices, or highest gasoline specifically prices right now, followed by kind of their bordering states, and with the lowest prices, relatively lowest prices, being in the Midwest, as well as parts of the South. Now, it would go to figure that people are probably going to start driving less in response to this. Prices increase and quantity demand tends to decrease. Here's a chart on the left here, kind of tracking over time since I think this is 2008 until 2017. You can see where there are the largest increases in gas price. You see the largest decreases in response to that in vehicle miles traveled, given in terms of the change from the previous year. However, what we are seeing now is, and I'll go to the next one here, is that actually the decrease, not only is it not uniform, but it doesn't necessarily follow the change in gasoline price. So overall, there was about a 2% decrease from where this data set was taken, which was the week of February 27th to the week of March 6th, which was, I think, that was a time of some kind of increases in the price of gasoline before somewhat of a decrease, and now we're seeing it increase even further. The top 25 states with the longest average trips, so the average a number of miles per trip being the highest, all 25 of those had a decrease in the average number of trips being taken. So we can see that despite those lower gas prices, there's other factors going on. A couple of those factors could be that, again, those trips are longer. Like I mentioned, all the top 25, those that are above average for the length of trips. They've seen all of them have seen decreases, as well as this kind of being a more agricultural area of the country. Then perhaps there's kind of more competition for that gasoline as a part of somebody's income and somebody's budget, going towards farm equipment and other methods. So it's really important to kind of keep in mind, and obviously across all these different states, they're also going to see differences in behavior between regions and between states or between counties, and particularly rural and urban environments. And while automobile travel is probably the biggest concern for people, particularly for consumers, we're also seeing some interesting kind of varying trends between different modes of transportation and for freight. Trucking has been kind of a big moneymaker for not just for shippers, but also just private entrepreneurs just renting a truck and deciding to ship on their own. That's been quite lucrative, but now we're seeing some of that freight demand slow. And this being a time for travel between spring break for for school-age children and for college students, as well as it kind of ramping up into a vacation season. Again, with that pent-up demand for many people, particularly for more shuttered states, wanting to travel and wanting to go on vacation for the first time in a while. If you've traveled by plane recently, you've probably seen the kind of insane pricing on many of those flights, particularly longer flights. And that just goes to show that despite air travel being highly dependent on the price of petroleum, people are meeting those prices and are still consuming at those prices.
Yeah, so one of the solutions or ways that we've seen this administration look at tackling this is, and looking at trying to reduce the squeeze on fuel prices and the general economy with inflation in general. Biden has said, he plans on resuming some leasing for oil and gas drilling on federal lands to, ease some of this pressure and increase employment in these industry sectors to just help the economy. Of course, this isn't a long-term solution, but that this is a good way to relieve some of the pressure, given because Russia is not going to be coming back as a global oil supplier anytime soon. So this is probably going to be here for the foreseeable future, 5 or 10 years. So the next simulation that I ran through is that looking at that hypothetically, making a lot of assumptions, looking at what this would look like. I increased employment in the oil and gas extraction industry, and we looked specifically in Louisiana in this state-by-state model. So increasing oil and gas extraction. So we increased employment by 5% in Louisiana. And then, a couple of years later, we started that employment immediately, and then we started to see a decrease in the price of gas and oil by, a small amount, by 1%, starting a couple of years later in 2026. And so that's how we set it up. Some of the variables that I used the same variables that I did before for the increase in gas and oil prices. So I looked at it on the consumer and industry side. So I looked at the fuel cost reduction for industries with the fuel cost variable, and I decreased that by 1% starting in 2026. And then I did the same thing on the consumer side with the consumer price for motor vehicle fuels by 1% starting in 2026. And then I looked at increasing the employment. So I used the employment variable to increase employment by 5% starting in 2022 in, just specifically Louisiana. And so here are some of the general Louisiana results. So, we're increasing employment. So we can see, the first couple of years, we can see employment ramping up. We're starting to drill on some more land. So, the oil and gas industries are, hiring more people. We're artificially inducing some of that employment. But, we can see, starting from 2022, all the way to 2026, we're seeing, pretty sustained increases in employment. And then 2026, we start to see that general, that bigger, that oil gas price decrease. But in Louisiana, that's a little bit more marginal of an impact, and we're looking largely at employment on the statewide level. So what we're seeing here is that as we increase the supply, as more oil and gas enters the industry, we're seeing that employment start to cool off a little bit, and we're seeing employment start to dip back down again. To people that can't see very well, the total employment is that blue line on the top. And we're seeing employment cool off a little bit as the oil and gas industry is starting to cool off a little bit with the increased supply. But we're also seeing that red line is output, and we're seeing output, having sustained increases with increasing drilling. We're seeing output continuing to increase, because we're also, providing support and helping consumers with decreasing that gas price. And then when we look at the general U.S. results, we can see, that employment in Louisiana is pretty small. So we're seeing, running up to 2026, we're seeing, a small increase in employment. Again, the blue line at the top is total employment. And then we're seeing a huge spike in employment as businesses see that 1% drop in fuel prices. So we're seeing across all regions, we're seeing, industries look and see that they're spending less money on fuel and things that they need to spend money on, and they're hiring more people. And then you can see, following that, of course, the labor market cools off a little bit more, and people start, the employment rate, dips a little bit, and finds a general equilibrium. The REMI model is a general equilibrium model, so it'll find that in the long term, and you can see employment dips back down to a healthy amount. And you can see, the red line output is also, continuing to increase. So relieving the pressure and the squeeze on fuel prices are help to sustain and increase output in the long run. And then, looking specifically at the transportation industry, as expected, the employment in, gas and oil is not going to impact the transportation industry in too meaningful of an amount. It helps a little bit. Increasing employment in any industry usually involves transportation in some form. And we have an input-output model. So a lot of these industries at least have a little bit of the transportation industry as a part of their industry. So employment, we're seeing a marginal increase starting in 2021 and 2022 from this policy of increasing employment. We're seeing a marginal increase in transportation, but we see it really take off as soon as those fuel prices drop down a little bit. And we're seeing these lines continue to go up all the way through 2060. Air transportation, that big green line at the top, of course, is really enjoying this reduced squeeze in fuel prices, followed by truck transportation. As we saw in the other simulation, they are the ones that are the most impacted by fuel price surges and decreases, and they are really taking off in terms of their output, from this alleviation of the fuel cost squeeze. So as a result we're seeing the transportation industry coming back. We're going to see trade flows and commodity access come back as well. So this will help alleviate some of the pressure.
Yeah, so that was just kind of an example of not only of a possible solution. The other one that we went over being kind of continuing the diversion to electric vehicles and to other forms of transportation and other forms of kind of freight conveyance. But just kind of some other more recent trends and kind of things to think about. If anybody has kind of questions going forward. I'm quite aware a lot of the pain that's been felt and a lot of the squeeze that's been felt has been on consumers, partially due to inflation, but then partially again to those specific resources that are both driving inflation, but are kind of very fundamental to day-to-day life. We've seen that oil companies are actually, despite there being issues with the oil market because of those increase in prices, they're seeing kind of record profits recently. I think these are both increased by about like 40% since Q4 of 2021, and then partially due to Ukraine's role as being kind of the breadbasket of Europe, we're seeing a massive increase similarly, and not quite to that 40% or so level since the beginning of the year, but a big increase in the food prices globally, which Americans are also feeling. But again, I think just kind of something to keep in mind is that when we're talking about inflation, we're talking not just about general access to goods and services, but also access to and the prices for specific goods and services that are driving a larger kind of inflationary effect. So you can see here, for example, the vegetable oil being at the biggest amount. Ukraine is the biggest exporter of sunflower seed oil, and partially due to that cut in production, the demand for other alternative oils, palm oil being one of them, have kind of skyrocketed, not just for end consumers, but also for its roles in kind of an intermediary resource for producers. But both of these kind of commodities, both petroleum, which we extract and then ship abroad for refining, as well as food production, are commodities that the U.S. has a major global role in producing. So in some ways, it may be an opportunity for U.S. Economy in different portions of the U.S. economy to kind of take a leading role in the production of those resources. Obviously, feeling the pain at the pump is drawing our attention not only to our reliance on fossil fuels, but kind of reminding us that maybe there could be a better alternative for this going forward. With gasoline having a higher price, there is starting to be a little bit more of an incentive, not only to head towards electric vehicles, which we have seen being used in a greater amount, just not across the board in terms of income or in terms of regions, but also for just other alternative forms of transportation, whether it's public transit, rail, active mobility. So it's definitely going to be a multimodal kind of approach to not only combating climate change, but also to responding to kind of this oil situation. And as I said before, the U.S. is really kind of blessed with a wider range of natural resources. We don't extract all of them, partially for environmental reasons. The reason why the production of electric cars has been so limited is because we were not able to, for safety reasons, extract those different metals from different U.S. stores. That is a policy decision, and some would say it's there are positives and negatives to it, obviously, as we see here, but it is something to think about. And as we also kind of alluded to, that the changes in demand and as well as the changes in kind of who feels the brunt of that inflationary effect depends on different modes and sectors, and as well as different regions, countries and states, but also within the United States, regions and states, as well as the kind of the purpose of that transportation. Maybe more leisurely activities are taking a bit of a hit in some areas just by driving, but one can never kind of underestimate the pent-up demand, both from the stimulus activities that was taking place during the pandemic, as well as just the kind of the desire to get out into the world for the first time in a while. So thank you everybody for attending. I think we'll kind of launch into the Q&A session. So thank you again. I think Amanda will be going through those. Yeah.
Yes, of course. Thank you so much for the presentation. You guys did an amazing job. And with that, I will kick off with the first question of today. And that is, even if the Biden administration reverses course on prohibiting drilling on federal lands, what can be done to increase refinery capacity?
It's a very good question. And, we ran this demonstration, with a lot of assumptions. There's a lot of different specific considerations with every single industry. I don't have a specific idea of how the Biden administration can do that to help, increase the oil supply and help to increase employment in those industry sectors. But that's definitely something that, we can take into consideration, once we get more details and more specific details as to how the administration is planning on tackling something like that. We can definitely model something like that and look at possible scenarios of how that can play out in the economy as well as on the industry sector level.
Yeah, and kind of to add on to that, you know, I think it's been posed as a solution for us to kind of just drill as much as we can in the United States, because that will solve our specific energy needs and make us independent of the global market. And besides just the facts of the global market, as well as the realities of kind of like the nature of the oil, it being like sweet or sour, we tend to export a lot of oil and then it's refined overseas. And then we import different kind of oil and we can refine it here. So I don't think I can give a specific answer to that kind of question. I know that refineries haven't really been built in great amount for a while. I think the last one might have been built in 2015 or so. So that may be a question kind of related to that infrastructure question of, you know, just a kind of a longer term infrastructure possibility.
Awesome. Thank you so much, David. The next question is, electric vehicles are great, but what is the source of power they use and what will provide baseload power?
Yeah, so obviously we've seen a big increase in solar and wind, hydroelectric. That's the most ideal kind of source of the power for electric vehicles. You know, we've seen different proponents, but you know, there being issues also with nuclear, that being, if not as sustainable or as having like as a good a kind of face, it also being an option, but that being also being a very, you know, kind of limited longer term solution. And we're also, another limitation of electric vehicles is just its adoption, you know, based on not just the cost, where there's not really much in the way of entry-level vehicles, but also a big part of it is just the actual infrastructure of supporting those vehicles. You know, I've seen the maps of that like Tesla puts out with where the chargers are, and you see more chargers kind of every day, depending on what state and if you're in a city versus rural. But you know, it's always going to be a challenge for that infrastructure portion as well. So I would agree that they're great, but you know, the larger infrastructure is always going to be a challenge for that kind of alternative.
Okay, great. Thank you, David. The next question is, how did you treat responses to high fuel prices like clean fuel and substitutes, such as biking, walking, carpooling, or remote work?
Yeah, so we did not look at that. We looked at it's an input-output model. So, you know, of course, electric generation, you know, some of the other alternatives, you know, biking, walking, other modes of transportation are all valid forms of transportation also, but we didn't really look at that in this specific model because we looked at, we had PI plus TransSite, which is our model that like looks deeper at the modes of transportation, would have more information and more insight in something like that. But looking at like clean energy, for example, you know, it's an input-output model, so we could look at electric generation and look at that IO table and see specifically in terms of like, well, where is this electric generation coming from? Is it coming from fossil fuels, coal? You know, we have built into it, we have industry averages, but you know, that can be shifted. We can make custom industries to look at, you know, clean energy alternatives and looking at the fuel price increases that would result, or how the fuel price increases would result different alternative industries. That would require us to go in an input-output table and make a custom industry ourselves. Since a lot of these, you know, clean fuels and alternative energy industries are a lot newer, and there's not a lot of good industry information that we have about it. So usually when we work on projects, you know, specifically looking at that, we usually work with the person to see exactly what information they have about that industry and how it's getting its energy and how it's you know, generating its energy, and you know, we create a custom IO table for that. And that can be reflected when you look at the energy prices. That'll be reflected based on how the different industries are interlinked.
Yeah, and I would also say that sometimes those kind of substitution effect is a big question with economics in general. But when it comes to kind of questions of transportation, a lot of time, travel demand model is a little bit more suited towards that. What the REMI model and specifically Translate is good at doing is kind of taking those different modes of transportation and translating them into kind of economic factors, like a general kind of amenity that makes a region more attractive to then live in. So in a way, REMI can track travel between regions, people settling down because it's a more attractive region to live in for a number of reasons, employment and price index, what have you. But when it comes to this specific form of transportation used to kind of travel within that region, then that might be more suited for a travel demand model that can be fed into Translate.
All right, great. Thank you, Phil and David. Another question for you is, this is a two-part question, so rather long. So I'm gonna just kind of read the question and then I'll give you the first part and then you can answer that and then I'll ask you the second part. So the question is, going back to the scenario where you're looking at the impact of fuel costs projecting cutting of truckers and transportation jobs. Do you want to go to that slide?
It's the pie chart one, or
Okay.
Yeah.
Yeah, we can definitely. Yeah.
Perfect. And then the first question to this is, how would you account for the extreme level of demand for products currently given?
The extreme demand of product. So I touched on that before. So there's an extreme demand. So specifically in this simulation, all these unemployment numbers a lot of it is driven by the decrease in demand for transportation. The increase in demand, as I touched on before, is something that is taken from other factors, not as related to the fuel price. So it's from factors like pent-up demand from COVID, other extraneous factors that are driving people to have an increased demand for the transportation industry. This specifically is looking at the occupations. So this is basically saying who in these transportation industry sectors are they going to lay off first, and they account for this decrease in demand by first, they're gonna cut employment for the motor vehicle operators because truck transportation demand's going down. There's less of a demand for trucks going from state to state. With the trade flow diagram that I showed, there's less of a demand for truckers to go. There's less of a demand for people to get on a plane and go on vacation, fly from Massachusetts to like Hawaii or something like that. So there's less of a demand for this transportation mode, and air transportation and truck transportation disproportionately. And we're seeing that they're specifically laying off motor vehicle operators, which are operating these routes that are probably not happening as much anymore, as well as air transportation workers. So these would be the people working at the airport and on the planes. They're getting laid off because there's less airplanes going to different destinations. And some of these other jobs are having declines as well. Information record clerks is one of them in air transportation, where they have less information to process and less record keeping as a result of decreased flights and decreased demand for flights. These are also the workers that they're going to be, these are the workers that they're going to be cutting off first based on the decrease in demand. So that's kind of a long-winded answer for the first part of the question.
I'll jump on that real quick. And obviously, if we've learned anything, is that despite increases in prices, that if there's a massive amount of demand for goods and services, then people are going to start paying those prices. I think I mentioned this earlier as well. Like, we've even seen an increase in kind of entrepreneurial freight of people kind of taking jobs and kind of driving between cities and with specific loads, not even being part of a larger trucking company. either purchasing trucks or renting them, and then trying to kind of, even with there being such increases in fuel prices, they're still turning a profit. There was a Wall Street Journal article. They're starting to see kind of a slowing down of that effect, but definitely something to take into consideration. And kind of this question of laying off of employees and going on from there. The airline industry is kind of a good example of this, where they saw, and obviously this isn't something that's going to be quite replicated probably for a long time in any other industry. Almost nobody was flying, so they laid off or furloughed a large number of employees. When flights started picking up again, I think they had about 10%. I forget if it was a specific company or an industry average. They had a 10% decrease in employees, while still seeing an increase in overall flight. And they just decided to try to see if that worked, and managed to turn more of a profit that way, even if there was maybe a bit of like a skimflation effect, if you've heard that term, where the overall service is somewhat reduced, possibly. So it will be interesting to kind of see if there is a kind of a reduction in employment in trucking, and maybe there's some other way for those companies to make up for that.
Okay, great. And the second part of the question is more of a statement, and I was wondering if you could do like a little quick recap on their statement, just kind of do a little conclusion of it. So the second part is, in our region, we're seeing an incredible demand for truckers and transportation related personnel despite high fuel costs to companies. Trucking companies can't hire enough people. So I guess the question is, do you have a quick summary on that?
Yeah, I think it's just that the insane amount of demand, honestly, that we've been seeing, and that's definitely something that we could put in the model. But I think just for time's sake, we didn't want to go into those different factors.
We could look at an alternative scenario, and I was thinking about doing this before this because there is an insane demand for some of these professions and industries right now. But we're seeing a lot of this being passed over to consumers, and we're seeing a lot of these costs basically be reflected and passed down to consumers because of how high the demand is. So we can model something like that by increasing the demand. We can increase the demand specific to the industry, as well as we can just look at that consumer price variable that I used and deployed before. We can just basically have all these costs, because a lot of these costs right now in the current economic climate are just being passed down to consumers. So we can just take that consumer price and we can jack that up for all the relevant industries and show what the economic impact is going to be from all the industries passing along these costs to consumers. And you can see that in the labor market as well. There's an insane demand for just jobs in general across the economy, but especially in some professions. So we can look at and examine exactly a little bit deeper with another simulation. Looking at these motor vehicle operators, seeing this increase in demand for them, and from the expansion of the industry. And I'm sure if we did another simulation where we looked at an increase in demand for the truck transportation industry, we would see motor vehicle operators would be the ones that are increasing the most. It would be the opposite. So as we're seeing demand decrease, we're seeing them being laid off first, but we're also seeing, probably with an increase, we're probably going to see that they're going to be the first ones employed, because there's going to be more of a demand for it, more trucking routes. There's going to need to be more motor vehicle operators. So we're probably seeing the flip side effect right now, or in your specific region, you're probably seeing the exact, parallel effect of that.
Okay, and we do have 3 more questions. I'm hoping to get to all 3 of them, but if we don't have time, we definitely will reach out to you through email. And so with that, the next question is, which California counties were treated as separate economic entiles in the situation
Yep.
in the simulation?
Yeah, so we have we have a couple counties. I would have to look at the model to see exactly what counties in California, but they were all in Southern California, around or close to Death Valley to Central California. I can't name all of them off the top of my head, but it was looking at, we basically broke out the counties in Southern to Central California that were, sitting right next to Nevada. And we broke out most of those counties. I think there were 8 counties there that we broke out specifically, or the model broke out. So, I mean, I can provide the exact counties that we looked at in the model or that we have in the model in an email. I just don't have it at the tip of my fingers right now.
Perfect. The next question is, do you have any environmental output metrics? I need to weigh the impact of extreme weather impact, for example.
Yep, we have, so we looked at our core economic model in this webinar, but we have models like Transite, which looks at some of the more transportation that focus things, as well as E3 Plus looks at captures the environmental impact. So you can look at, from the economic activity, we can guess and estimate what the emissions are going to be from that. So we can get estimations for what the projected CO2 emissions are, as well as what the social cost of carbon is going to be. And we've done a lot of work with that, primarily with consultants and utilities. We've done a lot of work using that model to look at renewable energy plans, as well as a lot of these renewable energy plans and alternative energy ideas, and seeing what the economic output would be, as well as the environmental output would be in terms of emissions. So we definitely touch on that in our models.
Yeah, and I believe in Transite, a couple of the gas or the emissions that we look at are like NOx and carbon monoxide. A couple more of those more kind of acute emissions. Carbon dioxide, I believe, is touched on with E3 Plus. I believe it's a little bit more diffuse. For when it comes to those transportation emissions, it's treated as kind of like a negative amenity, so it largely impacts people's preference for that region versus another region. So if there's a high amount of emissions, it's going to create smog and other concerns, and that's going to influence people's movement between regions, which is largely how it's treated. And if you come in with a travel demand model, a lot of the time that's a little bit easier to calculate. As for what was the extreme weather impact, not directly, but the REMI model was. This is I think probably one of the best examples of the use of the REMI model, as well as particular to this question. Kind of a forward-looking projection of the damages from Hurricane Katrina before it made landfall. I think that was Sandia National Lab. And then afterwards, the Army Corps of Engineers kind of, double-checked the work basically, and did a regressive look backwards and said that it was, I think it was like 95% about accurate, depending on the metric they were looking at. So it's definitely, any kind of shock, whether it's a economic disaster or environmental disaster. It's been used recently for COVID analysis, particularly those kind of shocks to the economy. It's really good at taking those.
We work extensively in Florida, and so a lot of what they're looking at is like weather effects, like what you asked about. So flooding, anything from flooding, hurricanes, any sort of natural disaster or some sort of, weather effect. It's just a question of how we can model that. And, the model has been used extensively for all types of those different scenarios.
All right, and we are out of time. So if there's any questions that you had I will have our associates reach out to you with those answers. And I just want to thank you again for attending today's webinar.
Thank you, everyone.
Great, thanks everybody.